Hi there, Professor Rod Dog here, back for video number 2. Um, we are going to just take a quick look. In our last video, we worked through what are our 5 main categories: assets, liabilities, owner's equity on the balance sheet, revenues and expenses on the income statement. We went through the debit and credit framework. I expanded briefly on the statement of retained earnings formula so that we can see why revenues are a credit. They're a credit because they increase owner's equity. Why are expenses a debit? Expenses are a debit because they increase with the debit. And why? Because the statement of retained earnings embeds net income, which algebraically is a product of revenue minus expenses. And retained earnings is an owner's equity account, as we can see here on the balance sheet. Owner's equity account. All of these bolded items are our 5 main categories: assets minus liability, assets equals liabilities minus owner's equity, revenues minus expenses equals net income. All of these other accounts are subtypes of those. Dividends is a contra equity, common stock is owner's equity, retained earnings is owner's equity, cash is an asset, notes payable is a liability, and on and on and on. We worked through these journal entries. We made all our records. We built the general ledger through T accounts. We actually did a check figure on the debits and credits, so we could ensure that we at least had debits equal credits for all of the journal entries that we did. I'll kind of walk through this slowly just so you can review it on your screen if you want to pause it. This shows the transaction and the corresponding journal entry, and of course the accounts. So you can pause that if you want to look at that again or go back to the other video. Without further ado, we are going to use the following information to create or build an income statement, statement of retained earnings, a balance sheet. We're going to do them in that order. Why are we going to do them in that order? Because we need net income to complete the statement of retained earnings, and we need retained earnings ending balance to complete a balance sheet. I got my balance sheet formula right up here. So that's the order we'll do them. The first thing I'm going to do, down here is I'm actually going to identify the type of account. I'm just going to do it verbally. We have a current asset. We have a revenue on the income statement, expense 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 on the income statement. Dividends are contra equity. We need that for the statement of retained earnings. Notes payable, we've got a current portion. That means it's a current liability. Accounts receivable is a current asset. Notes payable, this is the non-current portion. How do we know? Because it doesn't say current portion on it. That means it's not due for more than a year. That is a long-term liability. Prepaid insurance is a current asset. Long-term investment in land is a long-term investment asset. It's actually had given it away there. Stock held as investment, that's a long-term investment. Equipment is property, plant, and equipment. Accumulated depreciation related to the equipment is in that same section. Retained earnings beginning balance. Retained earnings is a balance sheet account. We're going to actually use this to build the statement of retained earnings. We come back up here. We need the beginning balance of retained earnings to start that statement. So we've got it right there. And this is the balance of January 1, 2018. We're building financial statements for December 31st, 2018. So this is clearly, very clearly, within the naming convention. This is our beginning balance of retained earnings. Common stock, owner's equity, copyright, trademarks are intangible, patents are intangible, building and related accumulated depreciation are property, plant, and equipment. Accounts payable is a current liability. There we go. We've got all four asset types. We have current assets, long-term investments, property, plant, and equipment, and intangibles. And we have both types of liabilities, current and long-term liabilities, on the balance sheet. We have the beginning balance of statement of retained earnings to do that, and so we have everything we need. I do have a check figure for us to look at later. I'm going to do my best to try to keep this in view. I'm actually going to move this check figure maybe right up here just so I can have room to build the financials. This company's name is Raw Dog. Let's see. Oh, and now that I've showed the hint, I'm going to kill it. I'm going to delete it. A bit of a softer word. I'm going to delete it rather than kill it. So here I go. What's the first thing I need to create? I need to create an income statement first, a statement of retained earnings, and then I need to create a balance sheet. So balance sheet here. Assets. So this is my order right here. 1, 2, 3. I have to follow that order. We always do it that way. Of course, I can be given scenarios if I have the data, just formulate any balance. Same thing here, you can kind of do math problems inside of these. I'm going to build these out. So we have Raw Dog Inc., Raw Dog Bakery. Sorry, Raw Dog Inc. is the name of my fantasy basketball team and my Yahoo fantasy league. Sorry for the confusion. That's funny. That's a funny joke. You should be laughing right now. It's actually not real. That's the name of my fantasy basketball team. Raw Dog Bakery sells hot dog buns and J Dogs and blah, blah, blah. So we've got the income statement for the year ended December 31st, 2018. I'm just going to get right into this for the sake of time. We have sales revenue. Yeah, the textbook, your textbook might have a little bit different formatting, but I'm looking for speed here in this video, and obviously to learn the concepts of how to build the financial statements. I've scattered this. This is not a true trial balance because it's not in order, but it's like I call it a scattered trial balance. It has everything we need to make financial statements, and let's assume this is an adjusted trial balance. Meaning we don't have any more adjustments to make. I'm getting a little ahead of us there because that's actually adjusting entries is actually in the next video. But let's move forward with that. Okay. So I've got I'm going to do revenues of $900,000, and then I'm actually just going to list out all of my expenses. I don't have any other revenues. So my other expenses, I'm going to come over. I'm going to do my best to create some sort of, I'm going to do cost of goods sold, salary expense, rent expense, utilities expense. I'm just doing the plus sign so I don't have to retype it. I don't think I have. The flaw that I have in this is that I should have depreciation expense. Forgive me. We can pretend that rent expense is depreciation expense because I made an error there. Hopefully you'll forgive me. So I have. I'm going to list these out. So cost of goods sold, salaries, rents, utilities. I don't have any other. I should have insurance expense too. Let's move on. That's okay. well, actually, I wouldn't have. I digress. Um, here's all of our expenses. So I'm going to just go total expenses. Again, I'm going to have a little bit of imperfection in my formatting, but for the sake of time, let's make it happen. I'm going to sum up those expenses. I've got a total of $739,000 in expenses. So that's my net income. My net income is revenues minus expenses. Okay. There we go. Pretty vanilla income statement. We expand the income statement later on in the course. So I've got 161,000. Well, let's do the statement of retained earnings. We've got. I'm not going to title this actually. Raw Dog Bakery statement of retained earnings uh, um, for the December 31st, 2018 year. I'm just going to write statement of retained earnings. So how do I start off here? I go beginning balance of retained earnings is beginning balance of retained earnings comes in at, it's actually over here on my financial statement. I had a hint right here again that said, this is the January 31st balance. Last year's ending balance in retained earnings is this year's beginning balance. December 31st, 2017's ending balance is January 1st, 2018. So there we go. That's at January 1. And then I'm going to go add net income in this formula, less dividends equals ending balance. Okay, so where do I get my net income? Well, I actually get it right up here, and then I deduct for our dividends, 25,000. So I'm just going to do a sum formula. Actually, it says less. So 25,000. The less implies that you need to deduct it. Again, the formatting is not my focus here. That's important. So, what do I have here? I have $10,000 plus 161,000 minus 25,000 equals 146. Plus this, minus that. My ending balance of retained earnings. Why do I need that? I need that to even finish my balance sheet. I'm gonna move this down. Again, I'm not gonna do the full title. What?
Hopefully my audio's back. I need to go check that actually. Take a quick pause here. Okay, we're back. I'm gonna actually I'm gonna move this trial balance. I'm gonna move this trial balance down. And I'm gonna do that so we can have some more visibility to our accounts. Actually, maybe I can put it right there. Okay, so we have our balance, Raw Dog Bakery balance sheet, and Now I'm having a conscience. What's going on here? Yeah, Raw Dog Bakery, balance sheet at December 31st, 2018. There you go. That might even be centered, whatever. I'm over it. Okay. Yeah. Okay. Our current assets. We always start with cash here. I'm going to actually do the same thing. I'm going to come over cash. What are my current assets? I should have identified this. I'm going to do it now. My current assets. What else do I have? Prepaid insurance. What else do I have here? Accounts payable, prepaid insurance, accounts receivable, current asset. Anything else? I think we've got it. So I'm going to say equals cash, and then of course I'm going to come here and I can cell reference that again. I'm going to say accounts receivable, and I have to make some adjustments here. Plus accounts receivable is 25,000. I have prepaid insurance, which is 15,000. Okay, so we've taken care of those. What's our total current assets? Let's see. Let's just get a little structure here. Make sure I'm in line here. Why aren't those lining up? That's really weird. That's okay. Total current assets. What's my total? I'm going to say equals the sum of those three. Okay, plus this, plus this, plus this. That's fine. That'll work. And then I'll do a soft underline there. Yeah, whatever. Okay. And then our next category is going to be long-term investments. And I think we have two of these. We have long-term investment asset, and then we have, they're right next to each other. So I'm going to say that's even going to make this harder. So I'm going to take these and move them out to here. Okay, so we've got our long-term investment at 15, and then we have stocks held as investment of 40. So I have total long-term investment of 55,000. Okay, and then we're going to go to property, plant, and equipment. I'll type it out here. Property, plant, and equipment. What property and plant and equipment did we have? We had, I think, equipment and a building. Yeah, here we go. PP&E, and I think we had a building. Yep, we did PP&E. So I'm gonna have my equipment less accumulated depreciation. Let's see. Equipment net, and then I'm going to have building. I'm going to have building less accumulated depreciation. And then I'm going to say building net. That's our book value. So we'll come here and we'll say equals this less this for a total of that's 130. Our building is going to be 300 less the 100,000. Remember, accumulated depreciation is a contra account. It's a contra asset. So its behavior is opposite of a normal asset. So our assets are increased by a debit, while a contra asset, which lowers an asset, is actually opposite. The accumulated depreciation account is increased here, which we'll cover more in our adjusting entries next time in our next video. But anyhow, that's how you get this negative number for deducting that. Just gonna drop that in there like that, make it clear. Anyhow, or no, let's do this. There we go. Okay, and then we have plus 300 minus the 100,000 of accumulated depreciation, contra asset, asset, asset. This is all of the depreciation we've taken over the entire life of the building. This is all of the depreciation we've taken over the life of the equipment. This is why I said I made an error. I should have depreciation expense up here. This is just a slight error. My apologies. We can still learn from building the financial statements just fine, even though I've made that error. And then I've got total PP&E, property, plant, and equipment is going to be the 130 plus 200,000. There we go. And then we get to intangible assets. Intangible assets, what do we have? We have copyrights and trademarks and patents. We had 15,000 and 8,000. We have intangible asset, accounts payable, unearned revenue. Let's see. Yeah, no, those are liabilities. So we've got our total total intangible assets is going to be 15 plus 8. Just make some consistent formatting here with what I've already done. Now I can get to total assets of the combination of these 70 plus 55 plus 330 plus 23. I believe this is our check figure, 478,000. Yep, our check figure was 478,000. Man, I'm glad that matched up. I didn't want to have another problem in here. But there we go. There's our total assets. I got to give myself some more room again here, and we are gonna do liabilities right up here. Just make sure I'm giving you some formatting that you can. Liabilities and stockholders' equity. I'll probably move this over just one so we can have it centered as best as we can. Okay. All right. And then let's just try to format as much as I can the way they like it here. So we've got current liabilities. We've definitely got some current liabilities. Let's come up again. I'm going to move this down for the sake of having more visibility here. Oh man, I have got to get these down out of the way. Okay, let's get this buddy moved down so we can have visibility to it in our liability section here. Okay, revenue, expense, expense, expense. We've already done those on the income statement. Expense. Statement of retained earnings. Statement of retained earnings. Yeah. Okay. Our current liabilities that I see are accounts receivable. Or not accounts receivable. Excuse me. Let's do our note payable, our current portion. For 20,000. That's a current liability. I know we have notes payable, the non-current portion. Doesn't say it's the current portion, so we assume it's a long-term liability. Common stock. Okay, we've got accounts payable right here that we need to bring up. That's a current liability, and we have unearned revenue, which is a current liability. And we will run those up here. What's my, oops. I'm going to put those consistent with our formatting here, and then I'm going to say total current liabilities. We're going to go plus these, just do consistent formatting with what I've done so far. Okay, and then we're going to go to long-term liabilities. What distinguishes between a current liability and a long-term liability? It's distinguished with mostly a year marker. If it's due in under a year, it's a current liability. Over a year, it's a long-term liability. We do have a long-term note payable, so I'm going to go long-term liability. And that is for, I might just bring it over here because I think it's our only long-term liability. It is. And then I'm going to do stockholders' equity or owner's equity. Yeah, whatever. I'll go stockholders' equity. Okay. Here we go. We have common stock. What do we have left? We got common stock. Whoops. For 180,000, and we have retained earnings. So this is owner's equity or stockholders' equity. Same thing, same word in this class. Don't know why that formatting is not the same. There's no super annoying. That's okay. Retained earnings. You might be tempted to come over here and grab this this item. Why would we not grab that item? It's because it's the beginning balance. We want December 31st. This is why I should have kept the title. We want December 31st balance. Is this December 31st balance? It's not. I had a hint in there that screamed out to you that it was a January 1st balance before I deleted it so we could do these financials. Where do we get this number? We get this number from the statement of retained earnings that we've already completed. Right here, the ending balance. I'm going to bring that number down. And now I can go total stockholders' equity equals this plus this. And then I say, oh, I need to go. I don't care what they do. I'm going to do oh man, what did I just do? Okay. Let's go insert. I'm gonna just go total liabilities. It's gonna be 82,000 plus these. That's my total liabilities. And then I'm gonna go total stockholders equity. I'll move this over to be consistent. And then I'll go here, and then I'm gonna say total liabilities and stockholders equity. Why? Because remember the balance sheet formula is assets equals liabilities plus owner's equity or stockholders equity. So I need to know the liabilities plus the total stockholders equity, and voila, I have finished out. Huge checkpoint here. Let's do a soft yellow on there. Does this tie out to total assets to make our formula correct? It does. What if I would have used retained earnings from the beginning balance? Well, I wouldn't have balanced, right? That's why I had to use the ending balance and retained earnings. Now, for conscience, I'm going to actually come up and fix this. This is our statement. Raw Dog Bakery statement of retained earnings. At December 2018, or is it for the year ended? Whatever. I think it's for the year ended. December 31, 2018. Let's see. Yeah. Whatever. Okay. Okay. There you go. We have now completed from our scattered trial balance data an income statement. We've completed a statement of retained earnings. I'm going to do a bigger box here. We've completed our income statement, our statement of retained earnings, and of course we finished off with a balance sheet. Did our balance sheet tie out? It did. It tied out because assets equaled liabilities plus owner's equity. I had given you a check figure that tied out, and here we are. I'm going to scroll one more time down slowly so you can see it. There's our income statement. There's our statement of retained earnings, and there is our balance sheet. I'll just scroll down so you can see our work. We have built the three core financial statements. We cover the cash flow statement much later in the term. It's been wonderful, my friends. Hope this helps. 20-minute video. We did pretty good on time. I was hoping for about 17, but I had to do some sweet jokes along the way. So there you go. Let me scroll the trial balance one more time. And there we are.